An $11 million trading model is running right now with a single comment hidden in the code that nobody will ever read. You are 22, with no finance background, competing against 10 math prodigies. By the end of this summer, you'll be the one writing it. The firm interviews just over 4,000 candidates a year for 11 intern seats, most out of 6 schools, most already holding a medal from a math Olympiad you have never heard of, drawn from the same narrow pool that 2 Sigma, D.E. Shaw, and Citadel are drawing from that same week, sometimes for the exact same person. On day 1, you are handed a toy dataset, a login, and nothing else, no syllabus, no rubric. Your desk sits between 2 researchers who do not introduce themselves for 11 days. On day 12, one of them looks over without warning and asks whether your feature set is leaking future information, which it is, and walks away before you can answer. You build 14 models over 10 weeks. 12 die in backtesting before lunch. One survives long enough to get quietly forwarded to a portfolio manager you have never spoken to, and you find out it's still alive only because you overhear someone say its name in a hallway 3 weeks later. Of the 11 interns in your cohort, 3 will get a full-time offer, and nobody tells you which 3 until the last Friday, over a 15-minute call with a director whose face you can't quite place. Some years it's 2. One year, mentioned once by a research associate who never brings it up again, it was 0. The offer starts at $240,000, and the director doesn't mention your 14 models. He mentions the 13th one, the one you rebuilt from scratch after it failed twice, and says that's the one they were actually watching. The Thursday before offers go out, the 2 researchers who share your row finally speak to you, both at once, both asking the same question about a covariance matrix you flagged in a shared doc 3 days earlier, and you understand, watching them argue about your own footnote, that you passed some test you were never told you were taking. The firm's total headcount sits under 300 people worldwide, small enough that the 11 of you make up nearly 4% of it for one summer. A fact nobody mentions but everyone in the cohort has independently calculated by week 3. A senior researcher, decades older than you, sits alone in a glass-walled room at 2 in the morning years from now, tracing a discrepancy in the overnight book back to a comment nobody has touched in a decade, and finds a set of initials that are not his. He will not remember, by then, that they used to be yours, and you have no way of knowing yet that this moment is even coming. $240,000, split into a base of $140,000 and a guaranteed first-year bonus of $100,000, buys you a real desk, a real login, and somewhere between $8 and $20 million of the firm's own capital, depending on how the risk committee is feeling about you that quarter. At a team lunch 6 months in, someone mentions offhand that a researcher who left 4 years ago wrote a signal in his second year that's still running in the book, has quietly cleared over $300 million since he left, and nobody at the table treats this as remarkable. You go back to your desk after lunch and open your own strategy, the one with your name on the internal wiki page, and spend 40 minutes rewriting a single comment at the top of the file, the one that explains what the function does, making it more precise than it needs to be for anyone currently working here. You don't examine why you did that. The honest promotion rate out of this seat is close to 1 in 3 within 18 months, and the firm never says the number out loud, because the not knowing is what keeps you rewriting comments at 6 in the evening instead of assuming the runway is long. A researcher 2 pods over is walked out on a Tuesday with a box and a handshake, no warning anyone below director level was told about in advance. And by Wednesday, his desk has a new laptop on it, and nobody says his name again. The signal that actually moves you forward is smaller than any of this. A Friday message from a portfolio manager asking to raise your risk limits, no explanation attached, which is the closest this firm comes to saying it trusts you. The next band, $390,000, opens the day that message stops surprising you, and you only notice it stopped surprising you a few months after it already has. 6 weeks later, in a scheduled one-on-one that runs 4 minutes, your manager tells you your risk limit is being raised, offers no reasoning, and moves to the next agenda item before you've finished saying thank you. And you spend the walk back to your desk trying to remember if he said congratulations, and are fairly sure he didn't. $390,000 puts your name on a strategy the firm now genuinely depends on, and dependence turns out to be colder than opportunity ever was. You're running $40 to $80 million, and for the first time, your Sharpe ratio isn't measured against a benchmark. It's measured against last year's version of you, a standard that only ever tightens. You start presenting at the quarterly review where all 60 active strategies get ranked on one screen, and the first time it's your turn, a director you've never spoken to interrupts 14 seconds in and asks why your Sharpe ratio improved the same month you changed your rebalancing window. A question built to sound like curiosity and function like an accusation. You spend the next 6 minutes defending a decision you made alone, in real time, in front of everyone who will vote on whether you keep this book. A junior researcher you're now mentoring asks you, quietly, after one of these reviews, what happens to a strategy that lands in the bottom third 2 quarters running? You give her the honest answer, which is that you don't fully know either, only that you've never once watched one come back. That night, a strategy you built 18 months ago starts bleeding for reasons you can't immediately explain, and you spend 6 weeks doing forensic work on your own past success because the alternative is watching someone else switch it off without you ever understanding why it broke. The number pulling you forward is $560,000, arriving with a title, Portfolio Manager. That sounds like a promotion and starts functioning. Within the first week, like a liability with your name already signed to it. You start keeping a private list, just for yourself, of every strategy you watch fall into that bottom third, and 18 months later, when you finally delete the list, 11 of the 14 names on it are gone from the active book, and the 3 that survived did so for reasons you still can't fully articulate in the review meeting when someone asks. The firm runs roughly 60 active strategies at any given moment, and only about a third of them are still alive 3 years after launch, decayed out by markets that eventually learn to anticipate anything that works too consistently, a fact you now understand from the inside instead of the outside. You keep the list going a while longer than you mean to, and on the night you finally delete it, you notice, almost as an afterthought, that you've started writing your own name at the bottom in pencil, then erasing it before anyone could ask why it's there. $560,000, split between a base of $200,000 and a performance cut that can double the total in a strong year, comes attached to a book, somewhere between $100 and $300 million, built by someone who left 8 months before you arrived. For the first several weeks, you're managing risk on positions you didn't choose and can't fully explain, reading his old notes for context the way you'd read a stranger's diary for clues. In your first quarterly risk meeting, you watch a peer get asked, in front of the full committee, to justify a single trade that lost $400,000. In the exact same flat tone, the committee will later use to approve a trade of yours that made $6 million, because the tone in that room was never about outcome, only about whether the reasoning behind the number can survive being said out loud. A recruiter calls mid-year with an offer to run a larger book at a multi-manager platform. You leave it unanswered in your inbox for 3 weeks, not because the number is wrong, but because you can name, precisely, the 2 things you still don't know how to do. 14 months later, your own firm offers you the same seat, unprompted, and the only thing that's changed is that this time you already know the answer is yes. Buried in the old PM's handoff notes, 7 pages long, is a single line with no context. Watch the correlation on the third sub-strategy. It lies. You don't understand what he meant until 11 months in, at 2 in the morning, staring at a spread that's about to do exactly what his sentence warned you about. And by then, he's 3 companies removed from anyone you could call to ask what else he knew. At the firm's one all-hands meeting of the year, the CIO puts a single slide up for 4 seconds. $31 billion under management. Spread deliberately across desks that don't talk to each other, so no single failure can take the whole book down with it. The slide changes before anyone can ask a question. You do the arithmetic on the walk back to your desk. Your own book, the one that's been keeping you up since February, is a rounding error against that number. And so, you realize somewhere around your own doorway was the win that felt enormous 3 weeks ago. $900,000, and for the first time, the money stops being the interesting part of the job. You're in the room now where capital moves between desks, and you see, for the first time, how much of the firm's total return traces back to a small handful of strategies, some of them not even yours, and how much of everything else exists mainly to diversify against the day those strategies stop working. You manage 3 or 4 researchers directly, which sounds collaborative until the day you have to tell one of them, in almost the exact words once used on you, that his strategy is being sunset after 4 years of his life. He asks if there's anything he could have done differently. You realize, mid-answer, that you don't actually know, and you say something true instead of something comforting. A managing partner tells you once, over a drink neither of you finishes, that the firm has shut down more strategies in the last decade than it currently runs, and that the ones still alive aren't a triumph so much as a residue, what's left after everything else got filtered out. The partners above you number fewer than 20 for a firm managing tens of billions, and the gap between your seat and theirs stops being about skill somewhere around here. It becomes about whether you're willing to put your own money in beside the firm's and lose sleep over both, and that willingness, more than any number you've posted, is the last filter before the final band. The researcher you sunset sends you an email 2 weeks later, not angry, just short, asking whether the strategy actually stopped working or whether the firm simply stopped believing in it, and you read the email 4 times over 3 days before you answer, because you're no longer sure those are different questions. The firm's returns land in the high teens this year, comfortably ahead of the broader market, and you know, in a way almost nobody outside this room does, that a disproportionate share of that number traces back to 2 strategies built by people who no longer work here at all. The figure attached to partner isn't really a salary anymore. It's a share, typically 2 to 5% of the fund's overall economics, riding on top of a base near 400,000 that would have changed your life a decade ago and now barely registers. There are fewer than 20 of you for a firm employing close to 2,000 people, and every one of them, from this year's 4,000 applicants down to the 11 current interns who don't yet know their odds, is quietly building toward the desk you had the year you arrived, not the one you sit at now. In your first year at this level, you sign off on capital increases for 2 strategies and wind downs for 3 others, and the weight of those 2 categories, which used to feel opposite, starts to feel like the same motion from this seat, the fund simply reallocating itself toward whatever is working now. In your second month, someone hands you, almost casually, a folder of anonymized performance data going back 25 years, the full internal history of every strategy the firm has ever run. You take it home and read it alone at your kitchen table for 3 hours, the way you once read a stranger's code at 2 in the morning as an intern, except this time nobody is testing you, and that, somehow, makes it harder to put down. That same month, a founding partner 2 decades your senior asks your opinion on a capital decision in front of the full partnership, genuinely asks, waits for the actual answer, and you realize afterward you can't remember the last time anyone in this building disagreed with you and meant it, because somewhere in the last few years, disagreement mostly stopped happening around you instead of with you. You approve, that same week, a headcount increase for next year's intern class, from 11 seats to 13, and you sign it without hesitation, the way something gets signed when you've long since stopped remembering it was ever a door with your own name written faintly on the other side of it. 22 years after the room with the toy dataset, you sit in on a risk review and watch a new intern's model get forwarded, without explanation, to a portfolio manager she has never met. You recognize the shape of it before you finish reading the summary, because it is close to the model you built the summer you were 22, the one you assumed had simply been retired decades ago. It wasn't. At a conference that same year, a researcher who left one of the older systematic houses mentions a number, the way a room mentions something it has already agreed not to discuss out loud. 66% average annual return since 1988. 36 years, not one losing year. A fund that stopped taking outside money in 1993 and now exists purely to compound the wealth of the 400 people who work inside it. Nobody leans forward. Nobody asks how. You fly home that night, open your laptop out of habit somewhere over the middle of the country, and pull up the file with your name on the internal wiki, the strategy you've spent 3 years defending in committee. You reread the comment at the top of it, the one you rewrote at your old desk at 6 in the evening, 20 years ago, making it more precise than it needed to be for anyone working there at the time. It reads clearly enough that a stranger could pick it up tonight and never need to ask who wrote it. And somewhere, over Kansas, at 11,000 meters, you finally understand that this was always the actual promotion, not the titles, not the 7-figure share, but the moment your handwriting stopped being visible in your own work.